Hey everybody, good evening. Welcome to tonight's live stream. I'm going to wait just a few minutes here and make sure we get everybody online who needs to be online. If you're having trouble getting online, let me know, drop a comment, or you can, I'm actually checking my email too. You can send me an email to info@standardgrain.com if you're having trouble getting on. But if you're having trouble on Facebook, try YouTube. If you're having trouble on YouTube, try Facebook. And we will kick it off here in just a couple of minutes. Um, to get started, for those of you who are already on, if there's a problem with the audio or the video, I've had some internet issues here the last day or two. I definitely had some this morning, I know. Let me know if there's some issue with clarity or if I'm cutting out. I may have to change a few things here. Um, if you want to start off the comment section, I want to try to make this as interactive as possible. Let me know where you're watching from. That was a great way to kick it off last time, and we had a whole bunch of people on the last live stream. I don't know how many we'll have on here tonight, but hopefully more than last time. I think we had 100 people on here at one point the last go around, so I'm hoping we can get to that same number. So if you're watching this thing, comment on YouTube, comment on Facebook. Let me know where you're watching from. We're going to try to make this interactive as we did the last couple times around. So I'll be answering questions throughout, and I will hang around here all night if need be to answer questions. I don't have to go anywhere, but I'm going to wait just another minute or two to start the actual recording. And I should have done that the last couple go rounds. I know people tend to tune in a little bit late. Let's see, we got Tennessee, we got Nebraska checking in. Like to get one where we could get at least every big Corn Belt state checked in. Maybe that would be nice. We're going to talk about capture and carry tonight, and it's going to be definitely a 101 series type. I don't know if I'll call it a seminar or a speech or whatever, but I'm going to try to leave you here with. We got Wisconsin checking in, Central Michigan. I'm going to try to leave you here with a better understanding of some of this stuff. I've got some really great charts to show you that should be interesting. And I'm hoping that there's questions. Remember, guys, if you're watching and you have a question, there is no such thing as a dumb question. There are other people watching who probably have the same question. So remember, this is a 101 class essentially. South Dakota checking in. This is a 101 class essentially. So there are no dumb questions. I'm imagining that everybody here is a beginner, has never seen any of this stuff before. So there absolutely is no such thing at all as a dumb question. We've got Northwest Ohio, Idaho, Western Illinois, South Dakota, a whole bunch of people checking in. All right, very good. I'm going to go ahead and kick off the official live stream here because I've got to record this for the podcast too, and I don't want to have all this pre-show chatter going on. So here we go. We're going to rock and roll. Hey everybody, welcome back to Grain Markets and Other Stuff. Thank you for joining me for this special evening edition. This is a live stream. I'm streaming live now on YouTube and also on Facebook. And our goal today is to talk about capture and carry. We're going to talk about how to capture carry, when to capture carry in these grain markets. We're going to run through some of the basic definitions. I'm going to try to keep this as simple as possible. I'm going to try to do this as if I'm speaking for complete novices. I'm going to leave out some of the more complicated stuff. I'm going to try to get to the stuff that I believe you need to know in order to accomplish this very thing in your farm operation. How do you capture carry? How do you go about doing it? What are some things to look for? That's kind of the general idea. Hey guys, if you like these videos on YouTube or on Facebook, make sure you hit that like button. If you haven't already subscribed to the YouTube channel, make sure you do that. It would really help me out to spread these videos around a little bit. And if you're listening on the podcast, make sure you leave me a review. Any sort of feedback, positive, negative, anything along those lines would really be fantastic. We've got some more people joining in as I speak here. So the first thing that I want to do before I get into this topic of capture and carry, how to capture carry, what does that mean? I want to run through some basic definitions, and there's only about 4 of them that I want to get through here. and then we're going to get through some basic definitions and then just one or two basic concepts. What's a carry market and what's an inverted market? When I talk about a carry market or I talk about an inverted market, what I'm talking about are the way that the calendar spreads are set up. So in a carry market, you have a market in which futures prices or deferred prices are higher than spot prices. This typically is something we've seen in the grain markets a lot, like up until 2020. When we're in well-supplied markets, markets that are bear markets very often, you'll be in a carry market where your cheapest price on the board may be your spot month price, may very well be your cheapest price on the board. That's a classic carry market. Now there are other types of carry markets, like I'm going to get into new crop corn later, which is a carry market in itself, although the old crop corn is not. So there are some intricacies, but in very simply, a carry market is where your nearby contract is trading below your deferred contract. The textbook definition for this would be contango or a contango market. You're not going to hear that term used as much in the grain industry, although I've heard it used. So it's certainly a term that could be used. An inverted market, or a market that is in backwardation, and backwardation is the textbook term that you're not going to hear a lot. Inverted or inversion is probably the term you're going to hear a little bit more often. That is when the current price or the spot price, your nearby price, is above the deferred price. And that's what we've got going on in the corn market and in the soybean market right now. We've got essentially our best prices on the board up front in our nearby contracts. And then we've got lower prices as we move out into the deferred months and especially into new crop. So those are like the two types of markets you can have in regard to spreads. There are also markets where you'll have what they call like a flat curve. Like say there's no carry, but there's no inversion. Like maybe the first 3 or 4 months are all trading at a very similar price. I'd refer to that maybe as a market with like a flat curve. But in regard to this conversation and capture and carry, this first definition here, a carry market is a market in which futures prices are higher than spot prices, or essentially your nearby contract, in the case of any spread, is going to be below your higher price deferred contract. That's what we're interested in. Here's a concept. This is a concept that you really have to understand to learn how capture and carry works, to learn a little bit about calendar spreads. It's not that complicated, but it's kind of complicated to explain, I found, as I was trying to put this presentation together. Carries are limited, inversions are limitless. So what does that mean? When you have carry in a market, when you have a nearby contract that is trading below your deferred contract, that nearby contract can only get so cheap relative to your deferred contract. And I'll explain why in a second. When you're in an inverted market or a backwardation market, there is no limit to how high that spread can go. So look at, just as an example right now in the market, look at the July corn contract, July 21 versus December 21 corn. July corn's trading over December 21 corn. There is no limit to how high July 21 corn can go relative to December corn. It could go $1 over December corn. July 21 corn could go $2, $3, $4, $5 over December corn, theoretically. No, I'm not making those predictions. I'm just telling you that technically those things are possible. So why in the other instance can we not go as far? Why is there a limit to carry in the market? It's not a complicated concept, but it's kind of complicated to explain. I'm going to talk about More Research. More Research is a company. They have a website. They talk about charts and seasonalities and spread markets in particular. This was the quote off their website. I'm going to start with this, and then I'm going to explain it. This is from More Research regarding full carry, and that's a term we'll talk about. Of course, markets rarely, if ever, reach full carry and normally do not go beyond 80% of full carry because professional speculators will step in front on the assumption that risk is minimal while potential is unlimited. This is the key part. If a market exceeded full carry, A trader or an entity could buy the nearby and simultaneously sell a deferred, take delivery, store, and then re-deliver against the deferred contract, all for a risk-free profit, as abhorrent to markets as is a vacuum to nature. So what they're saying, first off, is that risk-free profits are impossible. We know that, right? We know that risk-free profits are impossible. If there's too much carry in a market, if your deferred contract, let's say in the corn market, for example, if December 21 corn was trading $2 a bushel over our nearby, say, March or May corn, any trader or entity could buy all the futures contracts they could in that nearby month, that say March or May or July or whatever, and then simultaneously sell the deferred. They would cover all of their costs, their storage costs, which is storage, insurance, and interest. They'd cover their carry cost and then still have money left over for profit. That is not something that the market is ever going to allow. The cost of carry is storage plus interest plus insurance. And the CME actually kind of run away as a calculation. But essentially, these spreads are never going to go past full carry. And if they did, there would be free profit available, which is something that is not possible in markets. And when I get into some of these charts here, you're going to see exactly why that's the case when I get into some of these charts here, and exactly what the deal is with that stuff. I want to show you two charts, and they're examples of both an inverted market and a market that offers carry. The first one is a soybean chart. This is a new crop soybean spread. This is November 21 versus July 22. So here I've got the closes from today. November 21 beans closed at 12.11 and 3/4. July 22 beans closed at 11.63 and 3/4. So your nearby month is above your deferred month. That's an inverted market. It's not a market that's offering any carry. There's carry. Two markets, and inverted market, essentially. This is an inverted market. This is zero here. If we went below zero in this particular spread, I've got it charted. It's 43 cents over, meaning November 21 is 43 cents above July 22. If it went down to zero or below zero, we'd be in a carry market. Right now, we're above zero. November 21 is 43 cents above July 22. We're in an inverted market. So what's the market telling you to do at the farm? The market is telling you that you should probably deliver your bean harvest, because if you wait until July, the market's 43 cents cheaper, right? So it doesn't make a whole lot of sense right now. Now, this is something that, of course, when you get closer to harvest could change. And if we were to run into some monster crop or a big demand loss or whatever, we could very well have some carry in this spread. Now, let me give you the other example, which is corn. This is a new crop corn spread. This is December 21 corn versus July 22 corn. So December 21, of course, is going to be kind of like your big new crop month where you probably do a lot of your new crop corn pricing. And then July 22, of course, would be like the following summer. So just to put it in perspective, you harvest your corn in October, you maybe have it priced versus December. And if you were to put it in the bin and store it till summer, the following summer would be July 22. So in this instance, we actually have a little bit of carry. We have December 21 futures closed at 469 and 3/4 today. July 22 closed at 481. So you have in this market some carry, believe it or not, in the new crop corn market. And if you watch that episode I did a week or two ago, I talked about this exact spread and how there's some carry in it and how it should be watched. But in any case, there's 11 cents of carry here. And this is kind of where we get into the meat of this conversation. What is capturing carry and how do you do it? In this instance, capturing carry is you capturing this 11 cents. You want to take that 11-cent difference from Dece to July and somehow put that 11 cents in your pocket. Now, maybe 11 cents isn't enough for you to make it worth your while, and I'm going to talk about that later. But capturing carry in this instance would be trying to pocket this 11 cents on your corn bushels, right? That you are going to store from basically harvest through the, July, up until the July delivery period. How do you do that? So how do you capture carry? How do you take this 11 cents and put it in your pocket? There are only two ways to do it. Let me be very clear. There are only two ways to capture carry. There are two ways and two ways only. The first way to capture carry is to take an existing sale. Let's say you've got a sale versus December 21. It's either a futures contract or an HTA contract. They're probably not going to let you roll straight cash contracts, but a futures or an HTA contract can be rolled. The first way to do it is to take that existing December sale that you have, either a futures contract or an HTA, and roll it to July. So essentially, you're buying back the December while simultaneously selling the July, and you will now have a price that is 11 cents better because the spread is 11 cents. That's the first way to do it. You take an existing sale, either a future sale or an HTA, and you roll it forward. That is the first way to do it. The second way to do it is to take bushels that have not been priced and simply go all the way out to July 22 and price them or hedge them. Use some sort of option strategy, short futures, HTA, cash sale, whatever. That would be the second way to capture carry, is to simply go and make that sale versus the July 22 contract, and do 11 cents better than you would in December. And then you keep that corn in your bin until the July delivery period, and then you go ahead and deliver it. Is there any questions here before I continue? And guys, if you chimed in late, drop it in the comments. Drop where you're watching from, and if you have any questions at this point in time, this would be a good time to ask questions regarding this first little segment here before I get into the more, I'm not going to say complicated stuff, but before I get into some of the more key components here. And I really thank you guys for tuning in here tonight. Real quick, there's a website I'm going to talk about. It's More Research. This is their website. It's www.mrci.com. I have no affiliation with More Research. I pay for a subscription just like everybody else does, but they have a fantastic product, and I'm going to show you a couple of their charts. So I wanted to show you their website. And also, guys, remember, if you need some help from me, go to my website. It is www.standardgrain.com. Click on Grain Marketing Plan here. Guys, I send a newsletter out every morning. It goes out at 6:30 Central Time every business day. I make you aware of any overnight headline that you need to be aware of, all my grain marketing recommendations. I talk about stuff like this all the time: capture and carry, when to do it, how to do it. I kind of alert you when those opportunities arise, essentially. There's a text message service here. I've really kind of catered this thing to the farmer that maybe doesn't want to be a futures or options trader, or just has no interest in a trading account. And if you're somebody who's in that category, you don't want to trade futures and options, either you just don't like it, you had a bad experience, whatever. What I do kind of caters to that crowd. That's my goal in large part with this. So I wanted to show you that here before we continue. So if you have any questions about that, send me an email to info@standardgrain.com. This is a subscription. You can cancel it absolutely anytime. It's built to your credit card. If you want to try it for a month, sign up. You can cancel it the next month. You will not break my heart, I promise. Okay, so to continue here, I talked about the two ways to capture carry, right? We talked about the two ways. I showed you my example of a market that has carry. I guess the next question that I want to answer is, when do you capture carry, and at what levels should you seek to capture carry? Like, when is an opportune time to capture carry? I'm going to show you my favorite charts in the entire world. These are the charts from More Research that I talked about. And what these are historical spread charts. So I'm going to show you a chart of November versus the following July. Soybeans is the first one that goes all the way back to the early 1980s. These are my favorite charts in the entire world. They tell me more than any other chart. So you see the zero line here? This zero line is when when November out to the following July is trading even. When we're down here in my roll target zone, which is green, that's when there's carry. When we're above zero, that's when we're inverted. So when you're above zero, that's when November would be trading above the following July. When you're below zero, that's when November is trading below the following July. That's when there's carry to be captured. So you can look at this really simply. I mean, just looking at this chart, let me see if I can make it a little bit bigger. Just looking at this chart, what you can see here is that the spread barely ever gets, it barely ever offers more than 50 cents of carry. On a handful of occasions since the early 1980s, the November versus the following July has offered you 50 cents a carry on a handful of occasions. It actually did, in 2019, it definitely did. It got out to 50. But this green section here is a section that I added. This is not part of the more research. The green section in the roll target is stuff that I added. Basically, I can look at this chart and just know that if we get out to like 30, 35, 40 cents a carry, I've really got to start taking a serious look at rolling beans that I'm planning on storing. And I'm just using the Nov to July as an example, but these same sort of charts exist for November to March, November to May, November to August, whatever spread you want. But I want to look at the historical chart and know where these spreads have bottomed out so that I can target exactly where it is that I want to make that roll. So based on history, I know that if we get anywhere near 50 cents, that's pretty much a layup historically to go ahead and make that roll from November to July and capture that carry. Or if you're not going to make a roll and you have bushels that have not been priced, you just go straight out to the July and make that sale and capture the carry that way. Now, there are a couple of nuances and new issues that have come up here just in the last couple of years. This is technical and I'm not going to talk too much about it, but the CME group has increased their storage costs. So technically speaking, these spreads have the ability to get a little bit wider than they used to. If we get into a really big time bear market at any point, while these new storage rates are intact, this spread may go past 50. It could go to 60 or it could go to 70, but the same mechanism remains intact. And it goes back to what I told you, the definitions here about how carries are limited. So when I say carries are limited, this is what I mean here. See how we only go so far to the downside? Carries are limited because if you have too much carry, there's going to be risk-free profit available, which is not ever possible. It doesn't exist. There's no such thing as risk-free profit. So it's for that reason that you look at this chart, and I just know that if we get in this green neighborhood, and you could adjust this slightly depending on how you want to look at this chart, but I mean you get down here, this is go time. This is when it's time to make that roll or capture that carry by making a deferred sale. I have the same chart for corn. Where is it? Okay, so this is the December versus the following July historical corn chart, and it looks pretty similar, not totally not identical to beans, but historically you can see that when this thing gets down like to past that 20, closer to that 25 cent neighborhood, typically doesn't get much wider than that. 2008 was a goofy year, and we got out past 40 cents. That was probably almost like full cost of carry that year. But my roll target here is right at about 25 cents. If I get 25 cents of carry from Dece to the following July, that to me is a layup. Is it a guarantee that the spread's not going to go wider and you may have missed out on a little bit? No, it's not a guarantee at all. But just based on the historical data here, I know that like if I got 25 cents every year rolling my corn sales from December to the following July, I would be golden. And same deal with the beans. I mean, if I were to get 35 cents every year rolling my beans to the following July, I would be in fantastic shape. So this is definitely not a science. There's no way of predicting exactly where the spreads will bottom, but it is a guarantee virtually that the spreads will bottom. They can't go indefinitely to the downside here because of the carry issues that I mentioned, because there is no such thing as risk-free profits in the market, and that's exactly what happens if these spreads get too wide. And usually what happens, just like the quote from More Research, when you get close to that point, you'll have professional speculators just step up and buy these spreads because they know that their risk is limited. And that's a big thing that I think people, I think a lot of people do understand that. But since this is the 101 course, I thought that that would be a good kind of refresher. And it's a concept that is a little bit difficult to wrap your head around, but once you think about it a little bit more, the fact that like, okay, if you store it and you can cover all your costs, you could just store an indefinite amount and make money storing, and you could do it on paper. You wouldn't have to touch a bushel of corn. Like that's what these funds could do, or this large money could do if these spreads get too wide. So that's a big point here. The other thing that I wanted to talk about was timing. So we know the price levels that we're kind of looking for here in these two examples. Dees versus the following July corn, Nove versus the following July in soybeans. But when do you roll them? When do you go ahead and make that decision? When at what point in the calendar year or during the growing season do you roll them? My answer to that would be that it does not matter. If the carry's there, the carry's there. We know that the carry is finite, it's limited. So if they're offering you, let's say we have a total collapse of the financial markets in April this year, and Dees to July corn, Dees 21 to July 22 corn goes to 25 or 30 cents. You should go ahead and lock in that carry on any existing sales at that point in time. That's my opinion. That's not a trade recommendation. That's my opinion based on what I see here historically and what I've seen historically. So you do not have to wait. That's, I think, a misconception. I think some people think that you have to wait until harvest, or you have to wait until your initial sale comes due. Like somebody calls you and says, hey, you have to roll this HTA, or you have to price it or pair it to a basis, or you have to roll this futures contract. You don't have to do that. You can roll it whenever the opportunity in the spread presents itself. And this goes back to that episode I did a couple weeks ago. I said, guys, you got to start watching this Dees versus July corn spread now, because there's already some carry there, and it's not outside of the realm of possibility that it could get to a level that you would find attractive sooner rather than later, and you need to be paying attention when it happens. As a matter of fact, it's not even crazy to have orders working like down at some sort of level that you see fit, whether it be 25 under in Dees July corn or 35 under in Nove to July beans. That's not a crazy idea at all. I'm going to break here. Any questions about anything? I know I just threw a lot at you here in about 24 minutes. Is there anything that I need to go back and explain a little bit further? The most difficult thing, I think, was probably the concept of full carry, the reason why markets can't, the reason why carry is finite and not unlimited. Does everybody get that concept? Do you guys understand? Does that make sense to you? Because I think that might be the trickiest thing of all of this. If I'm not getting any comments here, I guess I did a fantastic job. Can you talk about the increase that the CME is talking about in carry? I heard that 2 years ago and still trying to see that in the market. Yeah, the market has yet to, put it this way, the spreads have yet to really flex their muscles and go out and test these new levels of carry that are now possible. It just hasn't happened yet. So personally, in my grain marketing, I'm sticking with the old numbers in terms of like when I should roll my corn or when I should roll my beans. I would imagine that at some point in the future, the next time we run into like a big time bear market, the spreads have the potential to go wider than they ever have, and that's probably when it happens. As an example, last year, so early in 2020, when USDA told us we were going to have a 3.5 billion bushel corn carryout, the spread from December 20 out to July 21 went to 28 cents a carry in the spring, like in April or May, when we thought we were going to have a 3.5 billion bushel corn carryout. So if that would have actually happened, like if that would have come to fruition and we ended up with a 3.5 billion bushel corn carryout, my guess is that you would have seen that spread from Dees 20 out to July 21 probably like really flex its muscles and go out and trade the widest levels it's ever traded. But we all know how that story ended. It just never, those numbers were all smoke and mirrors. It never came to fruition. But yeah, there's more carry possible now than there ever has been before because the CME increased this storage rate, which directly ties back to these big funds and entities who, if the market gets to a point where there's too much carry and they can make money just by simply buying and selling futures contracts simultaneously with no risk. Yeah, those levels are wider now. They're wider now. We haven't seen it reflected in the spreads yet. But I think the next time we get into some sort of like super bearish situation like we almost did last year, that's probably when you see that happen. That would be my guess. So yeah, that situation, the fact that they changed the storage rates, it's complicated things a little bit. It's not. I'd say there's more of a gray area. Like I used to be able to look at these spreads when before they'd really changed anything, and I knew that this stuff was like I said in the last episode when I talked about this briefly, it's not black and white, but it's about as close to black and white as you can get when some of this stuff got out to real wide levels. But now they've thrown this additional issue in with the storage rates, and yeah, the spreads have the potential to go wider. They definitely do. Any other questions? Crazy thing is that when I pull up that new crop corn spread, the interesting thing to me is that the you look at general sentiment in the market, you look at the way that the market's rallied. It's kind of crazy to me that there's actually carry in the new crop corn market. To be honest, I think it's really interesting that there's carry in the new crop corn market. You saw those US. This is kind of off topic, but you saw those USDA projections last week, and they're projecting, and I take these projections with a grain of salt. If I mean, I'm about like one step away from not even looking at them at all. But they're telling us that we're going to be pretty tight. Do the charts show that we have topped? Do you mean the spread charts? Is that what you're talking about? I would assume he means the spread charts. So spread. This is a little bit off topic, but like I said, I've got all night. Spread action in the spreads. Action in the spreads can sometimes be indicative of what may happen to flat price. Like sometimes the spreads will begin to sell off a little bit. Like we saw old versus new crop beans back off a little bit here, I think today. Some people would say that that is perhaps a forward indication of what may happen in flat price. It could also just be a simple correction in the spreads. Just like any indicator, it's not 100%. It's not even close to 100%. So you could have a string of days. You could have 2 weeks where the spreads are down every day, and it doesn't have to mean that the uptrend is over or that the bull market is over. It doesn't have to. It's an indicator. Like people, like some indicators, along those same lines. Weak spreads, weak basis. Sometimes people will say, okay, you look for weak spreads, look for weak basis, and that means that you've got a top coming in the market. But just like any indicator out there, whether it be a chart indicator, fundamental indicator, there is no indicator that's 100%. There really isn't, especially these days when everybody's got computers, everybody's got software, everybody's got charting capability. There is no indicator, technical or otherwise, that's 100%. We've got South Alabama chiming in. Can't wait to. I'm going down to Gunnersville fishing. We got our second bass tournament of the year is in not South Alabama, but we go to Gunnersville about 3-4 times a year, and I hope to get a little bit further south and do some fishing next year too. Any other questions about spreads, capture and carry, any of the charts that I showed you? I hope that I cleared up some of this stuff for you guys. Any other questions about anything? I'd be happy to sit here and answer any questions that you might have. I thought I kept that brief and concise enough, but I'm also exhausted, so I feel like I probably missed something. But if I did miss something or if I spoke over something, let me know. But guys, remember, go back and And this video is going to be available. The recording will be available on YouTube. And if you need to go back and look at these charts, just bookmark it and say, hey, I can go back and look at those charts, and remember where those levels are. Remember the kind of important spots to look for. These definitions are going to be in the video, of course, also. And I'm giving you guys I'm giving you a real, like, what we'd call a high level view of this deal. You can get really technical with the cost of carry and calculating it. And I know that a lot of the clearing firms and a lot of the brokers, they'll put out full carry calculations like every day of the week, that you can play along with. But it just, I think for the vast majority of farmers out there, I don't think that that stuff is necessary. I think you just need to know the general concept. I think you need to understand general levels to look for when talking about capture and carry. And remember, again, there's only two ways. There's only two ways to capture carry. You've got to either make that sale versus that higher price deferred contract or a hedge, or you've got to take your existing sale and roll it forward and pick up that carry. Those are the two ways to do it. You'll sometimes see trade recommendations from like brokers or clearing firms or whoever, and they'll tell you that you can capture carry by putting on some sort of calendar spread using futures contracts, and that is not the way to do it. It's way too much into speculative territory. It can get you into trouble. It doesn't really accomplish the task of capture and carry. So if somebody gives you that pitch and says, "Hey, we should buy December corn and sell July 22 corn on the board to capture carry," you're not going to really accomplish that. And I could probably do a whole episode on why and all of the things that could happen and the potential pitfalls of that. But that's another thing that I should have written down here that I did not. Any other, let's see, here's a couple other questions here. Would you be doing a call spread on these 21 corn sales that are already on the books as HTA? I've talked extensively on this podcast about re-ownership, and I am not a big fan of re-ownership. I tend to prefer re-ownership strategies. I prefer that they be used very, very sparingly and only in certain situations. I know that, so a lot of guys, I mean, any sale that you made versus these 21 corn today, prior to today, is what a lot of farmers would consider to be a bad sale. And I've talked about how I think the definition of what's good and bad needs to be changed. So just to put it real briefly, a farmer considers a good sale to be a sale that is like this: the market goes up and then you sell and then the market goes down. And that's what you can consider to be a good sale, right? A bad sale is when the market goes up and you sell and then it keeps going higher. And now you consider that a bad sale. That's the way a lot of farmers think. And I don't blame you for thinking that way. This stuff is mentally very, very difficult sometimes on you. I think I find it to be incredibly stressful, honestly. But no, it's not something that I recommend. I'm not telling you I think the market's going up or down. That's not my point. My point is that just in the grander scheme of grain marketing, I'm not a big fan of re-ownership. The times that I like re-ownership is like if I'm forced to make a sale at a price that I really hate because I need cash or for logistical purposes. Those are the times where I don't mind re-ownership as much. Like re-owning corn after a $2 rally, it's could be a way to make money, but it could also be a way to take the sale that you think is bad and actually make it worse. So no, I'm not advising that. And unless you're super heavily sold and you don't think you're going to have the crop, like you got 80% of your crop sold and now you've got a drought or something. There are some extenuating circumstances, but in general, no, I'm not a big fan of that. Is the Green New Deal going to help ethanol or hurt ethanol? I have absolutely no idea. Short-term future of ethanol is still problematic because we still have COVID and we still have lockdowns. And what you have, I think, permanently is a trend of people not commuting, people working from home more. Companies around the world, both big and small, have figured out what they can accomplish via email and telephone and web conference. I mean, look at what we're doing right now, guys. I'm sitting here in Middle Tennessee And I'm talking to you guys who are everywhere from, the Corn Belt to southern Alabama to Wisconsin to everywhere else, and it's all like pretty seamless. So that's going to be a problem for ethanol. Um, could the Green New Deal be good, be big on renewables? I suppose that it could be, but we all know that the end game here, it seems, is that everybody's pushing electric cars. Every auto manufacturer is pushing electric cars. GM wants to be 100% electric by 2035, and they're going to push to really make it sooner than that. Uh, does that actually happen? I have no idea. So I don't know. I mean, ethanol could have some good things short term. Long term, it's going to have a lot of problems, and we're going to have to find, in all likelihood, in the next 10 to 15 years, some different ways to use corn. I hope I'm wrong about that. I mean, I do, because I obviously, my business is working with corn growers, and I hope I'm wrong about that. What do you think could be a black swan event on the markets? That's a great question, and I have an answer for you. This year, a lot of people would say very closely mirrors what happened in 2007 and 2008 in these markets. And in 2007, it was in the summer, I believe, corn was trading like $3.50, $4 a bushel. And we had a very similar set of circumstances. We had a financial crisis, we had massive government money printing and stimulus, and we then saw this massive rally in the grain markets into 2008. Corn went from like 3.50, $4 in the fall to a peak of $7.50 by June or July of 2008. And what happened after that was just a phenomenal collapse. We basically went right back down to like $3. I think the board actually traded under $3 at one point in time. We went from 7.50 down to 3, like in the span of like 2 months. My fear, I don't even know if you would call it a black swan event, because a lot of people think that this is going to happen. But if you were to see some major collapse in, say, the equity markets, like the stock market, I think that that could translate into a lot of other markets. You got to keep in mind, large speculators are very heavily long the grain markets right now. Corn in particular is where they have their most length. They've also got a lot of length in the soybean market. If you were to have some sort of event that resulted in widespread liquidation across all these asset classes, like, first off, the equities start to weaken up. Then you get some of your commodities to start to weaken up. I mean, they're going to pull the plug on these long positions in the grain markets. I don't care what the fundamentals are. I think short term you'd have some real problems there. So I don't know if I'd call that a black swan event, but if I had to pick an event that was like really bearish at this point, it would probably be something along those lines. In the opposite scenario, what would a really bullish event be? I mean, the real bullish event's really obvious. It's the drought that's already across a lot of the plains into the western corn belt. If that doesn't stop, it pushes its way east, persists through the spring and the summer. Now you've got very tight U.S. corn and soybean balance sheets and a weather problem. And that's how you do something totally crazy off the wall in regard to upward price movement this summer. But it's a long ways from that. We're a long ways from probably either of those scenarios. But if I were to like give you my like one real bullish scenario and then one real bearish scenario, that would be it. I mean, the bearish scenario would be like big collapse in a lot of the outside markets. The most bullish scenario would be like drought, major weather issue here in the U.S. I would say those would be, and I don't even feel like the term black swan event is kind of thrown around too loosely these days. Like everything's a black swan event now. But yeah, I mean, if I had to pick two scenarios, like one that's really friendly, one that's really bearish, those would probably be the two scenarios. Any other questions about anything? All right, we'll give it another minute here, but I really appreciate you guys tuning in, and I'm gonna try to make these evening live streams a more regular event. I've got a lot going on. I'm coaching baseball again this year. We have our first practice on Thursday, so it's like I'm not. I'd like to commit to one night a week to do it. I've just got to figure out what that one night is. So I'm gonna try to make that happen. And if I'm not doing it every week, at least try to do it every other week and get on here and talk to you guys at length about some of these various topics. But everybody, thank you for tuning in. remember, if you don't, if you haven't already subscribed to the YouTube channel, to the podcast, make sure you do that. Have a wonderful night. I hope my internet connection is good today. I know it was garbage this morning. I hope to improve on that. Comcast is actually coming out tomorrow morning. So we'll catch you guys later. I hope I sound and look better tomorrow. We'll see you.